All right, everyone, let's do a quick sound check. Let me know if you can hear me. And if you can see my chart here, Barry, Chris, David, Deontay, Donald, Edmund, Fabio, John, all right, Marcus, Nick, Patrick, Prince, Reza, Rob, Robbie, Ron, Sam, Steve, Tony, Vito. All right, everybody. So good morning, everyone. My name is John Paul, founder of DayTradeToWin. Before we begin, a reminder that trading is risky. Please don't trade with funds you cannot afford to lose, and talk to your broker, understand the risks involved with trading. Good morning, everyone. So today I want to teach you something. Usually I do these webinars once in a while, and my purpose today is to give you an insight on where the market is going and what you could do, how to prepare for targets and stops, give you a general idea of the trading that I do at price action as well, software that I use, and maybe you can take away with what we're going to do today, and you could do it on your own as well, right? Test it, understand the better way, I think, in looking at the market itself. So a couple of things. First, we have on the E-mini S&P and the financials a rollover coming up next week. So as a reminder, all right, so what we're going to do today first is, if you're new to day trading, you can go ahead and download NinjaTrader. It's free. You can download here on the DayTradeToWin website. If you haven't done so already, we have a getting started guide. So this is a good way for you to download NinjaTrader, get free data, start trading and practicing in a simulated environment. I think this is important. The other thing that you could do is you can come down here to free stuff here under downloads, and you could go ahead and download. We have here the links for a news indicator for NinjaTrader 8. You can download that and try it, and this way you know if there's news that's going to occur right before you place a trade. And this is important because if the market is slow or it's fast and we don't know why that's happening, I would recommend looking at the news indicator to know if we have something that's important, especially with the FOMC and the current situation we have in the markets. All right, so we can go ahead, and we have other things here as well on the online calendar. If you use TradeStation, we have a bar timer, tick counter for TradeStation. So I have a couple of free things here, so go ahead and check out the DayTradeToWin free stuff section. And we also have a blog, which I put a lot of information here on the blog. If you haven't checked out the blog, go ahead and check out the blog. It's latest videos and information. All right, you got it. So what we're going to do is, I have here the Trade Scalper software up on my computer, and I have down here something called the ATR, the average true range. And the ATR is something that I think a lot of traders overlook, especially over the years when I teach traders. Do you know what the stop is? Do you know what the target is? Or do you know, more importantly, the current environment that the market is in? So when I look here at the ATR, if we take a look at where the market is right now, right over here, I can tell you that right now, yeah, I think I'll remove that. What we have right now is, as soon as the market opens, I'm using a 1-minute chart, just expect there to be a lot of volatility, a lot of action, a lot of movement, just a lot of buying and selling. This is not the optimal time to be jumping in to the market. Even though we see a lot of signals here for the Trade Scalper, we have to think about the environment that exists at the moment. So if I look here at this ATR, I'm using a setting of 4, which only looks at the last 4 candles. So the last 4 candles indicate that the market is moving at about 3.95. This is now in points, so it's about 4 points. And what this tells me is that if you use a target or a stop that is outside of these numbers, you could get stopped out early. Sometimes that happens to a lot of traders. They get in, they want to use small stops. And it's okay to use small stops, but at least understand the current environment that exists. So what we have here is, if I place the trade right here, right now, whether it's a long trade or a short trade, think about the kind of movement that exists. It's about 4 points. So I can almost guarantee you that the market will go up or go down this value of 4 points. Now, why is this important? This is important because if you have a stop that's 1 point, you can easily get stopped as the market goes up or as the market goes down. It'll stop you out because the market could move 4 points in either direction. So using a small stop is not going to help you. Can you use a large stop? You can, but I also warn you not to use large stops unnecessarily. On the E-mini S&P, the scale that I like to use is not more than 5 points here on the ATR and not more than about 1 point on the ATR. This is, I would say, the perfect area to trade. Anything above that is too volatile. You have to risk a lot. The market's chaotic. Anything smaller than that, less than 1 point, which really is indicating that every candle is working up or down at smaller than a 1 point range, this is not going to help you. There's a lot of chop and whipsaw. It's just going to stop you out with nothing there happening, right? The market's not moving. So what we want to see is first the environment. Is the market slow? Is the market fast? Or is it just right? So right now, since it's less than 5 points and more than 1 point, we can definitely trade. Now the second step would be, what about the stops and the targets? So I like to use a target that is roughly the same as 1 times the ATR. Now I like to go a little bit more conservative, so this 3.74, if you say I want to take 3 points or I want to take 3.25, that's fine, that's not a problem. But you can definitely expect this distance for the market to move either up or down. So if you wanted to take a trade and you said, no, my target's going to be 3 points or 3.25 points, great. This is in line with the current conditions. If the stop that you're going to use is 10 points, as you can see, it's too large. It's unnecessary. It has to be more in line with the current conditions. A little bit more, I would say, if the ATR is 3.5, risk 4.5, even 5 points at the most, at the maximum. But try not to just go for 2 or 3 tick stop. It's going to be too small, too tight. Because remember, the market just doesn't go up. It goes up and down. It moves up and down like this. So it's important to know, especially on the markets that everybody trades, whether it be the NASDAQ, whether it be the E-mini or currencies, look at the ATR. Again, I use a setting of 4, and there has to be a sweet spot, a range that you could say, this is where and when I want to trade. I talked a little bit here in the morning about not trading just as the market opens because of the volatility. As you can see here, it's kind of slow, normal, and then the market opens, the bell rings, and everybody begins to trade, and this increases. So we have to be ready for when the market jumps up. And if you're in a trade, obviously it can go up and down and have these large swings. In this case, it didn't really happen, right? So in this case, you can see that this signal, 38.18, got you in perfectly right here and kept on going up. So that's a good thing. But again, we don't know this is going to happen. I can just say that as soon as that bell rings, you have to expect there's a lot of chaos, and it could easily stop you out unnecessarily. So if I was, again, to take a trade right now, right here, I don't have a signal just yet, but if I was going to take a trade, I know exactly the type of conditions I'm in. The market's at about 3.25, so my stop has to be a little bit larger than that. My target can be 3.25, it can be 3 points. So I'm in line with exactly the conditions that exist. Does anyone have any questions? This is a live webinar, by the way. This is not a pre-recorded webinar. Steve, Alnur, Deontay, Marcus, Robbie, Edmund, let me know if anyone has any questions thus far. All right. So as we begin here, the other thing I want to show you is what happens when we have strong trending days. When we have strong trending days, there are certain things and certain characteristics that occur. In comparison, when we have markets that are whipsawing and choppy and just flip-flopping, and there are characteristics that you can take from both. So some of the methods that I teach are counter trend, which means that the market goes up, and then I'm looking for a situation to counter that trend. The roadmap does that. The X5 does that. There's a couple of methods. The price action scalping method I teach also is a counter trend method. When the market is trending, it just keeps on going and going and going. Then I can see a different situation where trying to counter and go against this trend is not going to help me, right? Because I'm fighting the trend and I'm trying to do the opposite. So the first thing that I like to do is understand the type of day that is unfolding. And you've probably seen a few videos on this. I have probably over 500 or 600 videos available, trading and teaching, all available for free online. But the one thing that I do look for is this idea that after the market begins to move, is it going to continue? Is it going to reverse and be one of these days where it goes up and down and up and down? Or is it just going to go straight up? So I offer a free method called the ABC method. Some of you may already know this. And what it does is it breaks down the day into 3 sections. I'm going to show you that in just a minute. And Cal says here, does the same limits apply to the YM? So every market's a little bit different, Cal. When you look at the Dow Jones, the YM, you have to look at the extremes, or even the currencies, or the NASDAQ. You have to look at the extremes that exist and when it's chaotic. So on the YM, I would definitely start off with the same idea, which is 1 point is 4 ticks. On the Dow, you may have to increase the amount of ticks. So 5 points here is 20 ticks. You may have to increase the amount of ticks when it becomes too chaotic. But the idea is the same. When the market's too volatile, too chaotic, we can see that it spikes. And so if you look back here on the, let me just go back here. And if you look back here and you can see the spikes that exist here, especially when the market opens, you can have a good sense of where you want to stay out of. So when I come here to this area right here, this is 10:30 yesterday, right? 10:30 yesterday. The market hopped up about 5.5 points to 6 points. This would be an area, if you look at the Dow Jones, where at the same time, you'd probably start seeing the market becoming more volatile. Go back to 10:30 yesterday and see what value that is on the ATR. If it's 30 ticks, if it's 20 ticks, if it's 50 ticks, whatever it happens to be, think of that as a spike, and you may want to just hold off. And as a day trader, it becomes too risky. So that's how I would do it, Cal. The ATR is, Jonathan says here, is different for all markets. That's the question. So when I look here, Jonathan, at the ATR, it's always the setting of 4, but the scale, the value of the ATR is different. Some scaling on the ATR is in points, so the financials works in points, and some are different for the oil and for the currencies. They work in tenths or thousands. So the scaling is what matters more than, we're still using a setting of 4, and it doesn't matter if it's a 5-minute chart or if it's a 1-minute chart or an hourly chart. It's exactly the same. So if you were looking, for example, at a 5-minute chart here, right over here, you can see that on a 5-minute chart, the ATR is much higher because we're using the last 4 5-minute candles. So the scaling changes per market, but it doesn't really change per time period. And so we're still using the same points, 5 points and 1 point for day traders. And if you need to drop it down from a 5-minute to a 1-minute for that reason, so we can still stay in between 1 and 5, you have to go down to a 1-minute chart. I think that was the question for Jonathan. So for different time frames, the rule is still the same, but the values that you see here and the way it works and the understanding that I can expect the market to move about 7 points on a 5-minute chart up or down, it's all the same, Jonathan. So let me know if that's clear. We're using the same idea regarding different time frames. I still want to make sure that it stays between 1 and 5. Steve says here, is a trending day a good time to use a trailing stop? And I would say definitely. Let me just forward that to everybody if I can. So when you have a trending day, the idea that the market is going to continue in that same direction, that's what we want. We can't do that when the market's slow. It's only when the market is a little bit more volatile that we can realize that there is trend involved. I've never seen a trending day where the market is slow or the ATR down here is very slow. So whenever you see the ATR, see if I can find a situation where the market's slow. So if you see here, it's not really that slow, but you can see here more so when the ATR is closer to 1 in this here, there's not really a trend. It's more up, down, whipsaw. And here, I'll expand this out here so you can see a good example of what I mean. So overnight, after hours, you can see the market moving here at about 2 points on a 5-minute chart. And what does it do? It goes up, it goes down, it goes down, it goes up. It just kind of stays sideways. It's not a strong trend. In comparison, when the ATR begins to increase here a little bit, now we're at 3 or at 4, you can see more of a trending action. So I want to understand that a trend usually occurs when the market is more volatile. When the market is slow, it just whipsaws and chops around. So you can see here, this is above 5 points. So I would say be careful. At the same time, you can see that the market begins to go and continue. So it's just a common situation where the market is moving and trending up or down because the volatility. When it's slow, it chops around. Steve, let me know if you're good with that. So the stop should always be in reference to the ATR, always, Steve. So you can't use the same stop when the market is slow in comparison to when the market is fast. So when the market is slow, the stop, let's say the ATR is at 1 or 1.5, your stop should be a little bit more than that value. So for example, right now you can see that the ATR is close to 7 points. If you were going to trade right here and right now, the market, the stop would have to be a little bit larger than this value, than 7 points, which I think is too much. At this point on a 5-minute chart, it's too much. If I dropped it down to a 1-minute chart, the ATR then adjusts for the last 4 minutes. And so now the stop would have to be closer to 5 points, just a little bit more, because again, remember, the market goes up or down this distance. So I can already expect that this candle is going to be equal to this value, or maybe just a little bit more, a little bit less. But you have to realize that this is the expectation. So you have to have a stop that's within reason for that. Steve, let me know if you're okay with that. Cal, you're welcome. Deontay says here, I'm new to trading. What would be the best futures market to trade as a beginner? I would say the E-mini S&P, which is the ES. You can see it up here, the ES 0321, which is March 2021. There's also, as a beginner, Deontay, I would recommend the micro E-mini S&P, which is, it works the same way. The market is going up and down, similar to the E-mini S&P. A little bit of a difference, but it's not too much. But the risk is much smaller. So you could trade the micro E-mini as a beginner, which, every trade, it will be worth a couple of dollars. You're not going to, be an instant millionaire trading the micro E-mini, but at least as a beginner, more importantly, you learn, you practice. When you start trading live, if you make or lose money, it's more experience on the micro E-mini. And the micro E-mini is MES. It's the MES contract, which is right here, MES Micro E-mini 0321. Right? So if I click on that, you can see as this updates and changes, you see it's exactly the same. It's just the Micro E-mini. It's the dollar value, and the amount you lose or the amount you make is much smaller. It's 1/5, or 1/10, I should say, 1/10 the amount. All right, Deontay? And then once you're ready, especially we have a lot of volatility now, and then once you're ready, you can go to the E-mini S&P or the micro NASDAQ or the NASDAQ as well. So we have a short signal here, 38.1350. So instantly, my expectation is that if I go short at 38.1350, this should be close to my target, right? That should be my target, about 5 points. And my stop has to be just a little bit more than this to keep me in the trade. So think about the relationship between, at the moment when you enter, what is the market doing? And so the ATR tells me that the last 4 candles that have plotted, that's what the ATR is doing on average. So we have 1, 2, 3, 4. These 4 candles right here dictate what this candle is about to do. And I can almost guarantee you that it's going to move 5 points, right? So if I went from here to here, it's already made 6 points, right? So this, to me, is invaluable. You can't trade with a 1-point stop or 2-point stop under these conditions. And at the same time, you don't have to have a stop that's so small that it instantly takes you out. So just a couple of things here that as price action is involved, we should know, we should understand. The other thing is the ABC method that I want to discuss here. This method, I do offer a free indicator with the ABC, with the at the open method, but you don't even need it. In reality, you can do this on your own. It's really simple. I try to keep things as simple as possible. When you start adding so much moving averages and MACD and momentum and all these things on the chart, sometimes we don't know what to do. Everything looks confusing. So really try to keep it simple and basic. The ABC method, if I go back to yesterday, and we'll keep an eye here on what happens here. 38.1350 would be the entry to go short, right? 38.1350 would be where I want to go short, or within a tick of it. And remember, there's different orders. There's limit orders, there's market if touched orders, there's stop orders. So there's a little bit here for, especially for the beginners, to learn the type of orders that exists when you enter in a trade, what kind of order that you're looking to use on entry. So the ABC method is this idea that we break up the day into 3 sections. And when you break up the day into 3 sections, what happens is, here I'll open up a new chart. What happens is we have the beginning part of the day, which we're in right now. We have a middle part of the day, which is this idea that it's lunchtime. But in reality, it's not really lunchtime. People around the world aren't having lunch the same time that I am in New York Eastern Standard Time. So the B part of the day is more of a way that the market slows down and catches its breath. And then we have the C part of the day, which is the last part of the day. So let me open up here a new chart. I keep this one open here. And we'll use the E-mini S&P. E-mini is a very good market to trade, lots of liquidity and lots of volatility, which we want. And at the same time, I want to make sure that it doesn't get too volatile as well, right? That's a situation that I want to stay away from. So when you look here at the, here, just bring this up here. When you look here at the breaking up the day, and I'll go here back to yesterday. Here, I'll try to put 2 charts here on the screen. What I want to do is I want to look at isolating the 3 parts of the day, A, B, and C, every 2.5 hours. So if I go back to yesterday here, you're going to see the 3 parts of the day outlined. So 9:30 for me Eastern Standard Time starts off right there, and then 12 o'clock right about here. So this is the A part of the day. Okay, A part of the day. And the A part of the day here has its own characteristics. As the market usually has news events, the market is a little bit more volatile. So we have already an understanding of what to expect. Expectations are really good when you trade because we know that the market does certain things during the first 2.5 hours. There's news, it's more volatile. It creates a range as well, which is what I'm going to use here to help me understand what happens next. So when the market is moving now in the next 2.5 hours, the B part of the day, and this happens to be from, remember, I'm Eastern Standard Time, so this is 9:30 to 12 p.m. Eastern Standard. This is, again, another 2.5 hours. This is from 12 p.m. to 14:30, which is 2:30 Army time. When you have this here occur, this is very important. This tells me whether or not the market is going to continue in a trend up or in a trend down. Every trend, every day that is a trending day, so this is very important, every day that is a type of trend that we can look back after the day is ended has this characteristic. The market usually breaks out of the range of the highest high and the lowest low. And when it does, it usually continues. Maybe it doesn't continue right there and then at the moment, but it usually continues and ends higher. The day will end higher. So if you know that, if you know the day is going to be a trending day, or lower, I should say, so higher or lower, I'd like to see in this B part of the day, the market continue to just go higher, 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 or lower, lower, lower. So it's important to understand that this relationship between the A part of the day and the B part of the day typically dictates if we're going to have a trend. What's more common is that the market does not trend. It stays stuck. It goes up and down and up and down. This resistance and this support is respected in the B part of the day. So when I look at a trending day at about 12 o'clock, 12:10, 12:15, I say to myself, is the market continuing to push, push, push higher or lower? If it does, it's almost certain that we're going to go much lower or much higher. The day will just turn into a strong trending day. And you can use that because when the market is moving at a slow pace or it's whipsawing, you can't hold on to a trade, expect it to continue. It'll take a very long time if it does at all. But when we have this characteristic of it breaking beyond the first 2.5 hours and breaking the resistance and the support created in the A part of the day, or the first 2.5 hours, instantly we can see the market just move and continue. So this is something that I use if I want to trail a stop. I realize it's a trending day. I can see that I don't want to fight the market either, right? If we're looking at continuing to move higher and higher or lower and lower, you don't want to fight it. You want to instead go with it. You don't have to counter trend and try to force the market to reverse on every single trade that you take. So look at this as ABC between the A and the B. Now the same thing is true between B and the last part of the day, which is C. It's a little bit smaller. We have here the range created like so. And when the market breaks above or below this B part of the day, which also creates its own resistance and support, we have what's called a late day rally or a late day sell-off. So there's earnings reports. We have FOMC news at about 2 o'clock, 2:30, around this time, which the Fed may raise interest rates or lower interest rates. We have Powell speaking. So we have all these things that may occur news related that will push the market into a rally or a sell-off. And we use this B and C, this relationship between these two, to tell me whether or not the market will rally or sell off. So you can see here that the market, right as 2:30 rolled around, it broke lower. Now this by itself may give you an opportunity to be a seller. You just jump in and say, I'm going to go short. But at the end of the session, it went lower because it sold off. So when I see the market break between, or I should say break above or below the range of B here, opportunity is knocking. The same thing between A and B. When it breaks, it's an opportunity for a trend. Let me see, questions here. I recommend, Steve, MIT market if touched orders, and I recommend them because sometimes, not so much with this kind of environment where the volatility is really good right now, we have a lot of healthy volatility, but I recommend that when you try to get filled and it touches your price and you're not filled, that becomes a problem. It becomes an issue where it touches and touches your price. So market if touched alleviates that problem. It touches and you're instantly in the market, either in a target or in an entry. So MIT orders is my recommendation. Limit orders, there's no slippage. So that's what you could use when you don't want any slippage, a limit order. But it doesn't guarantee a fill. A market if touched always guarantees a fill. You may have slippage in your favor as well. Or you can get the exact price. Sometimes you get a tick worse, right? A tick of slippage. But MIT is the way to go. Limit order would be a way to avoid slippage. All right, Steve? Okay, so let's take a look here at this trade here at this short here at 38.1350. So 38.1350 is right about here. 38.1350, right about there, right? So the short was here. The ATR tells me, which is really high, 5.83. If you want to take 4 points, 3 points, 5 points, 2 points, this here tells me that you're capable of taking that profit. So this is what the market did. Now there's another thing that I like to do with stops is not just have one stop. If you're new to day trading and want to learn more on the benefits of trading the markets, visit DayTradeToWin.com, join the next mentorship class starting later this month, and subscribe to the Day Trade to Win YouTube channel. We focus on price action and work exclusively with new and beginner traders who want to learn more on how to prosper from trading.